Our guest on Newsmakers this week is Texas Congressman Jeb Hensarling, who is the chairman of the Financial Services Committee. Congressman, before we get started with our two reporters here, I wanted to ask you, we're taping on this Thursday morning. There's news out of the European Central Bank that they are beginning a bond buying program of their own, sort of like our QE2 program with the Fed here. What's your reaction to this and its potential impact on U.S. markets?
Well, I haven't seen the news, so thus I have not studied it. I certainly have concerns over the extended quantitative easing policy of our own Fed. I fear that the extraordinary measures of 2008 are now turning into the ordinary measures of 2015. I fear that there could be asset bubbles that are being created, and along a lot of different lines of federal policy, including monetary policy. I fear that we could be making the same mistakes that helped lead to the 2008 financial crisis. But I haven't seen the news out of, so I'm not really qualified to talk about it at the moment.
Okay, thank you. Let me introduce our two reporters who will be asking you questions today. Clea Benson is financial regulation reporter at Bloomberg. Zachary Warmbrodt is Politico financial services reporter. And Clea, you are up first.
Great. So, Chairman Hensarling, President Obama has recently proposed a $110 billion tax on big banks as part of his tax reform suggestions. What are your thoughts on that? Is that the right approach?
Well, I hardly believe that a tax increase qualifies as tax reform. Tax reform is about making the tax code fairer, flatter, simpler, more competitive, so it has nothing to do with that. This is just the next chapter of Obamonomics. I actually say the next chapter. This goes back to a 2010 chapter of Obamonomics. He has proposed this tax or fee in the past. Then it was, the rationale was punitive. Today, the rationale is to make our markets supposedly less risky. I guess I would ask the question, what was Dodd-Frank all about? Is this a tacit admission that Dodd-Frank has failed? Or is this a false premise? Because all of the firms that supposedly, and the details are kind of sketchy, I admit, but as I understand it, all the firms that the president would apply this fee or tax to can all be designated too big to fail firms by the Financial Stability Oversight Council of Dodd-Frank. They can be functionally controlled by the federal government. They can have enhanced capital standards. You look at the Volcker rule, you look at the derivatives title. Again, it just begs the question, what is it for? Well, I know what it's for. This is a lot more about politics than it is economics. It's a lot more about the politics of division and envy than it is the economics of growth and opportunity and financial security. So we have to help Americans. The great irony is that all the president's rhetoric is aimed at the wealthy, yet all his policies have helped the wealthy. They're the ones who've gotten ahead. And so as the president declares victory on the economy, I think that's going to come as news to a lot of hard-working American taxpayers who haven't felt victory in this economy. And we need a regulatory burden that doesn't hurt our small businesses. We need to make sure that middle-income families have rising paychecks. We need to make sure they have great career opportunities. We need to make sure that they have competitive, transparent, innovative credit markets, vigorously police for force, fraud, and deception. But regrettably, Dodd-Frank has institutionalized too big to fail. The regulatory burden has made the big banks get bigger, the small banks get fewer, and the taxpayers get poorer. So there's a lot of work to be done.
But Chairman Hensarling, the White House says that this is a bipartisan idea to tax the banks, and they point to former House Ways and Means Chairman Dave Camp's proposal last year to tax the big banks. I mean, did Congressman Camp just have a bad idea?
Well, I'm amazed that the White House has the chutzpah to use the term bipartisan. I sat very patiently through the State of the Union, which lasted about an hour, and I remember 55 minutes devoted to what the president insisted he had to have and what he would veto, and then spent about 5 minutes telling us that we all had to work together. So, you know, it may come as a surprise to former Chairman Dave Camp that he and the president are so simpatico. I am a student of economics. It's what my degree is in from Texas A&M University. I know of no society that has ever taxed its way into prosperity and to growth. And so, again, this is just an old Democrat idea. Again, this is the politics of wealth redistribution, but we got to create wealth before the president can redistribute it. And under Obamonomics, we continue to have the slowest, weakest recovery in the post-war era. And in struggling, hardworking American taxpayers, middle-income families, they're suffering because of this. Their paychecks are smaller, their bank accounts are smaller. It has failed, and this is just, again, a recycled chapter of Obamonomics. It does not work. You cannot help the job seeker by punishing the job creator, and that's exactly what the president is trying to do. And, you know, the president doesn't believe in trickle-down economics. Well, he ought to believe in trickle-down taxation, because as he taxes these financial institutions, ultimately that becomes a tax on hard-working American taxpayers trying to buy a car, trying to buy a home, trying to get a line of credit to start their own small business and achieve their version of the American dream. It's trickle-down taxation.
Well, speaking of middle-income families, what are your views on the president's proposals for tax breaks for second earners and child care? Are those good ideas?
Well, what I believe is we need a fairer, flatter, simpler, more competitive tax code. I would be willing to take all the credits and all the deductions and trade them in for lower marginal rates. This isn't just theory, it is history. When we do this, we promote economic growth for everybody. We have an American economy that works for everybody. So this is still, to some extent, Washington trying to pick winners and losers. I want greater economic opportunity for all Americans. And again, what the president's trying to do is to tax some to benefit others. He's still trying to redistribute income and redistribute wealth when we need to be creating it. So I would say to the president, why don't you work with us trying to create a fairer, flatter, simpler, more competitive tax code, one that individuals could fill out on the back of a postcard. As we well know, most of these current deductions are used by higher income individuals. A lot of the people that he claims will benefit from all his plans can't even use them in the first place. So again, how do we get a healthy economy? I don't think the president's plan does it. I know we're in divided government, but I didn't hear much from the president in his State of the Union that he had much interest in working with Republicans on any common plan. I heard a whole lot more of my way or the highway is what I heard.
Zachary?
So on your committee, House Financial Services Committee, I mean, you have a chance to implement some of these policies you're talking about. What is one priority that you'd like to accomplish this year? What is one bill you'd like to send to the president's desk?
Well, I may have a greater ability to vote on these proposals than I have to implement them. Last I looked, the president still has his infamous veto pen. He may be storing up with extra ink at the moment based upon his State of the Union. Again, what we have to do is we have to get a healthy economy working for all Americans. So here's what we have to do. Today we have an unsustainable housing finance system. Whether you look at mortgage originations, whether you look at mortgage securitizations, you would say that the federal government is still controlling roughly 85 to 90% of that market. We've got to get off this boom, bust, bailout cycle. And I fear under government control that once again we're repeating the same mistakes in the past. I mean, when the president talked about reducing risk in the economy with his bank fee, I mean, his administrations helped leading it as when for example, Fannie and Freddie, controlled by the government, controlled by my former colleague Mel Watt, who heads up the FHFA, and you know we're very famous for our acronyms here in Washington, but they just lowered the down payment requirement to 3%. I mean, we got years and years of statistical history that shows that the default rates will be greater. We need to give every American an opportunity to buy a home they can actually afford to keep. So the answer to your question is housing finance reform, a sustainable housing finance system, one that gets us off the boom, bust, bailout cycle, one where there is competitive, transparent, innovative credit markets, that is a huge priority. And if you allow me, I'm sorry, go ahead.
Before you go on
Yes.
to your next on your list, Clea Benson has a question about housing finance.
Right. Well, so I wanted to ask, last year you had a bill that would basically wind down all government support for the housing finance
Well, that's not
system.
true, because the Federal Housing Administration was still around, so I would push back on your characterization.
Outside of the FHA, but basically wind down.
Well, it has a pretty big footprint in the market, but go ahead.
So wind down Fannie and Freddie and not
Yes.
replace them with a government backstop.
That is true.
The Senate, however, had a bipartisan bill that would replace Fannie and Freddie with a government backstop. Do you think this year that you would be more willing to move more in that direction and compromise with the Senate version, or are you planning to move forward with something similar to what you were doing last year?
Well, as you may recall, there is a change in management at the United States Senate, and I, for one, think that's a good thing, and clearly the American people do too, since they overwhelmingly voted out Harry Reid's obstructionist policy. So I think you would see a very different Senate bill today. Listen, I have strong beliefs about where public policy ought to go, but I always stand ready to compromise policies in order to advance. I don't ask myself, is this the perfect bill? I ask myself, does this bill take a step in the right direction, or does it take a step in the wrong direction? So I'm always interested. I'm always willing to sit down with the administration, certainly willing to sit down with my colleagues in the Senate and find a way forward, again, to a sustainable housing finance system. I don't often go across the pond and look at Europe for ideas on public policy. But I do note that there are a number of modern industrialized nations around the world, including Europe, that have very healthy housing finance systems and have nothing remotely resembling our government backstop Fannie and Freddie. So again, it's not just theory. I have evidence that you can have a successful model. And in what we call the jumbo market, that I know you two are familiar with, a segment of the market that Fannie and Freddie did not serve, you had liquidity, you had competition, you had innovation, and you did not put the risk, the credit risk, on the taxpayer balance sheet. So again, I don't believe there is a role for government in the secondary mortgage market to backstop it and take this credit risk and put it on the taxpayer balance sheet. And again, it's not just theory I have evidence. That's the idea I plan to lead on, but I'm willing to sit down with anybody and try to negotiate in good faith.
So where are two specific areas, and housing may be one of them, where you can sit down with the new Senate Banking Committee Chairman, Richard Shelby, and find something you can work on and send it to the president's desk?
Well, negotiating with Chairman Shelby is the easy part, but I think you know, under what we might call either unique or arcane Senate rules, it's still going to, for most legislative matters, take at least a half a dozen Democrats to advance any particular proposition. So it's not just dealing with Chairman Shelby, but I've had a number of conversations with my Senate counterpart. I'm very optimistic there's a lot that we can work on. One thing we have to deal with is just the sheer weight, volume, complexity, cost, ambiguity of the Washington red tape burden, particularly on our community financial institutions. Again, since the passage of Dodd-Frank, the big banks have gotten bigger. The small banks have gotten fewer. Consumers are seeing free checking go away. They're seeing the dreaded monthly fees for credit cards come back. Consumers have been harmed by many aspects of this. So I know that I can work with Chairman Shelby on this, but the unfortunate reality is that for some Democrats, Dodd-Frank is now viewed as sacred text. It is viewed as something chiseled on stone that came down from Mount Sinai. And yet on the House side, in the last Congress, we passed a number of bipartisan bills, some of which were just very modest clarifications or modifications of Dodd-Frank, but they all died in the Senate because now, the left hand didn't know what the far left hand was doing, and the far left hand has decided again that Dodd-Frank, the brand, regardless of what's happening to struggling middle-income American families, this is sacred text. We can't deal with it. I'm hopeful that more moderate and more rational members of the Democrat Party, however many of those may be around, will work with us, because any bill that's 2,000 pages long, probably the most dramatic legislation to affect our capital markets since the New Deal, I mean, it's just fraught with unintended consequences. There are some aspects that we ought to be able to work on a bipartisan basis, and I'd call upon my Democratic colleagues again. Look at what's happening to your community financial institutions. Look at what's happening to the families in your districts and states, and work with us on a bipartisan basis.
Well, so what are of examples of pieces of the regulatory law that you think should be able to be changed with bipartisan support this year?
Well, number one, what's fascinating is former Chairman Barney Frank, one of my predecessors, came and testified before our committee on the 4th anniversary of the Dodd-Frank Act. Obviously, he's a cheerleader for it since it bears his name, but fascinatingly enough, he indicated 4 or 5 different areas that if he were in Congress, he would be willing to modify, including the asset level at which firms can be designated as what we call SIFIs, basically these too big to fail firms. He indicated, I believe, and you can go pull the transcript, that he doesn't believe that asset managers, outfits like Fidelity or Schwab that help manage money for a lot of working families, that they should be subject to be designated too big to fail firms and subject to these enhanced standards that are going to cost more money. I think, again, hopefully there is some common ground on dealing with the plight of our community banks and our community credit unions that are just absolutely withering on the vine. They didn't cause the financial crisis, but they're becoming collateral damage. I would hope that there could be some common ground there. We'll otherwise have to see, again, dealing with the Democrats on the Senate Banking Committee, because they're going to have some cooperation with Chairman Shelby. We'll have to see what the legislative market bears.
We have about 7 minutes left. Zachary?
And you mentioned this threshold in Dodd-Frank. It's $50 billion of assets, above which banks have to abide by too big rules. I mean, do you believe that that threshold should just be raised to a higher number so fewer banks are caught up, or do you think it should be eliminated in favor of a test of some kind with different criteria?
I would absolutely get rid of any de facto or any legal definition of a too big to fail firm. I do not believe there is any financial firm in America that is too big to fail. Now, our financial system is too big to fail, which is one of the reasons we continue to have the discount window at the Federal Reserve. But I don't believe any individual firm is too big to fail. And in America, if you lose your ability to fail one day, you're going to lose your ability to succeed. And what's happening here is when you designate these firms as too big to fail, what you're really doing is designating a special class of firms, and investors say, well, it's less risky because the government has designated them too big to fail. We know there'll be a government backstop. It becomes a self-fulfilling prophecy. And what we have is, again, more control by Washington. And if we're going to build this economy, we got to build it from Main Street up, not from Washington down. So number one, I would get rid of the too big to fail designation. Number two, I would get rid of the taxpayer-financed bailout fund, which is contained within Dodd-Frank. Dodd-Frank didn't end too big to fail. It codified too big to fail. Number three, although not in my committee's jurisdiction, I would work with our Judiciary Committee. And at the end of the last Congress, Chairman Goodlatte was able to produce a new section or chapter of the bankruptcy code to deal with larger financial institutions so that they could be resolved in a better way. But it's bankruptcy, not bailout. So would I raise the threshold? No, I'd get rid of the threshold.
Well, so some of these changes that you think are possible through with Democrats. So, as you mentioned, I mean, the president...
Well, I'm more hopeful than
I'm hopeful. Well, so where do you think the president is on this? Because during the State of the Union, he threatened to veto any significant rollback of Dodd-Frank. And so, I mean, do you think that the White House would allow some of these changes that you're talking about?
Well, I'm quite confident. I don't know the answer to your question. I do know that recently Perhaps it gave the president a bad case of indigestion, but recently he signed into law two very modest modifications of the Dodd-Frank bill. But I do fear, particularly based on the State of the Union address, that the president's interested in circling the political wagons and doing everything he can to define his legacy as Obamacare and Dodd-Frank, notwithstanding him declaring victory in Afghanistan and Iraq. I do not believe that peace in the Middle East will prove to be one of the president's legacies. And again, I just find it ironic that former Chairman Frank, the Frank of Dodd-Frank, has even indicated several areas of his signature law he would be willing to compromise on, that he now sees are unintended consequences. I don't think he views it as sacred text, yet apparently the president does. So I know for a fact the president has signed into law two modifications of Dodd-Frank. Again, these are very bipartisan. There's a lot of Dodd-Frank that falls along a very partisan line, but the modifications that have been brought forward are in many respects clarifications of this 2,000-page law, have been overwhelmingly bipartisan, and yet the president seems to be circling the wagon. So time will tell. I don't spend a lot of quality time with the president, so I don't really know what he's thinking.
Just 3 minutes left.
So looking beyond Dodd-Frank or bank rules, can you tell your constituents are areas where you can work with the president and get something done across the spectrum?
Well, again, I don't know what the president's willing to do. I'm always willing to compromise policies to advance principles. The main thing is middle-income America is suffering, and we have got to build this economy from Main Street up, not Washington down. And if the president's going to circle the wagons on Dodd-Frank, it's going to be hard to find progress. And so I would, if I had a chance to talk to the president, I don't have all that many opportunities, I would just have him look again at the sheer weight, volume, and complexity and cost of all of the rules that he's imposing on our financial system that translates into more expensive credit and less credit opportunities for those who are trying to buy a car to go to work, somebody who's trying to amass a little bit of capital and start their first small business. At one time, the president seemed to indicate several years ago that he and his administration were interested in finding a sustainable housing finance system when they put out their housing finance white paper several years ago. Regrettably, it's been left on the shelf to gather dust. I think most people have now deleted it from their hard drives because the administration hasn't done anything on it. But I hope to have conversations with Secretary Castro and Secretary Liu to see if they have any willingness to work on that. So, it's kind of how I approach most matters in Washington, high hopes and low expectations.
Final question, Clay Benson.
Yes, so you're going to have your former colleague Mel Watt up in front of your committee this week. What are you going to talk to him about?
Well, regrettably, again, I think that Mel, and when he was on the committee, I highly respected Mel. And so we've served together for well over a decade. But having said that, I fear that once again he's helping lead the way to creating the exact same dynamic that led to the housing finance crisis in the first place, which was essentially government policy that either incented, cajoled, mandated, or incentivized financial institutions to loan money to people to buy homes that they ultimately couldn't afford to keep. We do not need Washington controlling our mortgage system. Again, we need competitive, transparent, innovative markets, vigorously policed for force, fraud, and deception. But if he's going to start taking the taxpayer balance sheet and saying anybody with 3% down can now buy a home essentially backstopped by Uncle Sam and the federal taxpayer, he's going to put a lot of people into homes that ultimately cannot afford to keep them. That's what led to this in the first place, principally the affordable housing goals of Fannie and Freddie. And I fear that institutionally, my dear friend Mel Watt may have a very short memory.
Chairman Hensarling, that's it for our time. Thank you so much for being our guest on Newsmakers this week.
Thank you for having me.